Question 1. Which of the following is not a typical feature of a universal life insurance policy? A. Flexible premiums. B. Flexible death benefit. C. Guaranteed cash value accumulation. D. Investment component tied to market performance. Answer: C. Guaranteed cash value accumulation. Explanation: Universal life insurance offers flexibility in both premiums and death benefits. It allows the policyholder to adjust the death benefit and premium payments within certain limits. However, unlike whole life insurance, the cash value accumulation in a universal life policy is not guaranteed. The cash value in universal life policies is dependent on the performance of the insurance company's investments or the interest rate credited to the account, and it can fluctuate. This differentiates it from guaranteed cash value policies like whole life insurance. Question 2. Mr. Thompson, an insurance producer, receives an application for life insurance from a client who did not disclose a recent hospitalization due to a heart condition. The application is accepted and issued without this information. In the event that the insurer discovers the omission, which of the following actions is most likely to occur? A. The insurer will void the policy because the insured provided false information. B. The insurer will issue a policy amendment to include the omitted health condition. C. The insurer may void the policy due to material misrepresentation or non-disclosure. D. The insurer will increase the premium to reflect the unreported condition. Answer: C. The insurer may void the policy due to material misrepresentation or non-disclosure. Explanation: Insurance policies are contracts based on utmost good faith, meaning that all material facts must be disclosed during the application process. If a life insurance applicant fails to disclose significant medical history like a recent hospitalization for a heart condition, this omission can be deemed a material misrepresentation. If discovered, the insurer has the right to void the policy under the principle of rescission, especially if the misrepresentation or non-disclosure was a key factor in the insurer's decision to accept the risk. This is in line with standard insurance law and practice. Question 3. Scenario question. Mrs. Roberts, a 45-year-old woman, is reviewing her life insurance policy. She realizes that she has no rider for accidental death and dismemberment (ADI), but she is concerned about the possibility of serious accidents due to her daily commute. She asks her insurance producer if adding this rider now would provide immediate coverage. What should the insurance producer explain to Mrs. Roberts? A. The ADI rider can only be added at the time of policy renewal and cannot be added in the middle of the term. B. The ADI rider can be added anytime and coverage will begin immediately after underwriting approval. C. Adding an ADI rider will require a new application and medical examination. D. The ADI rider can be added immediately, but there will be a 30-day waiting period before the coverage becomes effective. Answer: B. The ADI rider can be added anytime and coverage will begin immediately after underwriting approval. Explanation: Riders such as ADI can typically be added to an existing life insurance policy at any time, provided that the policy allows for it and the underwriting process is completed successfully. While some riders might require additional underwriting, like health screening, the coverage is effective once the addition is approved by the insurer, not necessarily tied to the policy renewal date. Therefore, Mrs. Roberts can add the ADI rider at any time, and her coverage will begin immediately after the insurance company reviews and approves her request, assuming no further underwriting restrictions are involved. Question 4. Which of the following is the most accurate statement regarding the time limit on certain defenses provision in health insurance policies? A. It allows insurers to deny a claim based on pre-existing conditions after 2 years from the policy issue date. B. It allows insurers to deny coverage for an illness after the insured has been covered for 5 years. C. It prevents insurers from denying a claim for a pre-existing condition after the first policy year. D. It prevents insurers from denying a claim based on misstatements of age after the first 3 years. Answer A. It allows insurers to deny a claim based on pre-existing conditions after 2 years from the policy issue date. Explanation: The time limit on certain defenses provision specifies that insurers cannot contest claims based on pre-existing conditions after a period of 2 years from the issue date of the policy, unless the misstatement of age or fraud is involved. This provision protects the policyholder from having their claims denied due to health conditions they may have had before the policy was issued, as long as the condition wasn't intentionally omitted or misrepresented in the application process. Question 5. Which of the following is not a standard feature of a guaranteed renewable health insurance policy? A. The insurer can increase the premium rate based on the insured's claims history. B. The insurer cannot cancel the policy as long as premiums are paid. C. The insured has the right to renew the policy for a certain period of time. D. The insurer can change the terms of the policy after the first year. Answer D. The insurer can change the terms of the policy after the first year. Explanation: a guaranteed renewable policy means that the insurer is obligated to continue renewing the policy as long as premiums are paid. However, while the insurer cannot cancel the policy or change the terms, such as benefits, after it is issued, they can adjust the premium rates for the entire class of insured individuals. The key distinction is that the insurer can only increase premiums based on the class's overall experience, not an individual's personal claims history. Therefore, option D is incorrect. Question 6. Scenario question. John is reviewing his group health insurance policy through his employer. He is concerned about his coverage for dental care, which he believes is essential for his overall health. The policy includes dental coverage, but John is unsure if he will have access to this benefit if he leaves his current job. What should the insurance producer explain to John regarding the continuation of dental coverage? A. John can continue his dental coverage under COBRA if he loses his job, but he will need to pay the full premium. B. John will lose his dental coverage if he leaves his job, as it is only available during employment. C. John can continue his dental coverage under the Consolidated Omnibus Budget Reconciliation Act, COBRA, only for 6 months. D. John can convert his group dental insurance to an individual policy at the same premium rate after leaving his job. Answer A. John can continue his dental coverage under COBRA if he loses his job, but he will need to pay the full premium. Explanation: under the COBRA Consolidated Omnibus Budget Reconciliation Act, employees who lose their job or experience a reduction in hours may continue their group health insurance coverage, including dental benefits, for a period of up to 18 months, sometimes longer for specific circumstances. However, the individual will be required to pay the full premium, including the portion previously paid by the employer. This is a key provision in the law that ensures continued access to health insurance coverage even after employment ends. Question 7. Which of the following health insurance riders provides additional coverage in the event of an accident, covering the insured's medical expenses and providing a lump sum payment for accidental death? A. Guaranteed insurability rider. B. Waiver of premium rider. C. Accidental death and dismemberment rider, ADI. D. Disability income rider. Answer C. Accidental death and dismemberment rider, ADI. Explanation: an accidental death and dismemberment ADI rider is a specialized rider added to your life or health insurance policy that provides additional benefits if the insured dies or suffers serious injuries due to an accident. This rider typically pays a lump sum benefit in the event of accidental death or dismemberment, such as the loss of a limb. This rider does not cover natural death or illness-related medical expenses, but only those resulting from accidents. Question 8. Which of the following best describes the concept of insurable interest in life insurance policies? A. Insurable interest exists when the policyholder stands to gain financially from the death of the insured. B. Insurable interest exists when the policyholder can demonstrate a legitimate financial or emotional interest in the life of the insured. C. Insurable interest exists when the policyholder has the legal right to name the insured as a beneficiary. D. Insurable interest exists only in business-related life insurance policies. Answer B. Insurable interest exists when the policyholder can demonstrate a legitimate financial or emotional interest in the life of the insured. Explanation: in life insurance, insurable interest refers to the policyholder's legitimate interest in the continued life of the insured. This interest can be financial, such as a family member or business partner, or emotional, such as a spouse or close relative. The requirement of insurable interest ensures that life insurance is not used for speculative purposes. It is a fundamental principle of insurance law that prevents someone from taking out a life insurance policy on another person unless they can demonstrate a valid reason for doing so. Question 9. Which of the following statements about the taxation of life insurance premiums is correct? A. Premiums paid for a life insurance policy are deductible as a business expense if the policy is for key employees. B. Premiums paid for a life insurance policy are always deductible for tax purposes. C. Premiums paid for life insurance policies on an individual are not deductible for income tax purposes. D. Premiums for a life insurance policy are only deductible when paid as part of a group insurance plan. Answer C. Premiums paid for life insurance policies on an individual are not deductible for income tax purposes. Explanation: life insurance premiums are generally not tax deductible for individuals. However, premiums paid for group life insurance policies through an employer may be deductible depending on the structure of the plan. If life insurance is used for business purposes, e.g. key person insurance, the premiums may be deductible as a business expense, but this depends on specific circumstances. It is important to distinguish between personal and business-related insurance when considering tax deductions. Question 10. Which of the following is true about the non-forfeiture options in a whole life insurance policy? A. Non-forfeiture options allow the policyholder to exchange their policy for a term insurance policy. B. Non-forfeiture options include the ability to reduce the death benefit to prevent policy lapsing. C. Non-forfeiture options allow the policyholder to cancel their policy and receive a refund of premiums paid. D. Non-forfeiture options allow the insurer to forfeit the policy for non-payment of premiums. Answer: B. Non-forfeiture options include the ability to reduce the death benefit to prevent policy lapsing. Explanation: non-forfeiture options are provisions in whole life insurance policies that protect policyholders from losing the policy if they cannot afford to pay premiums. These options allow policyholders to reduce the death benefit, convert the policy into a paid-up policy, or receive the policy's cash value. The goal is to provide an alternative to policy cancellation in the event of non-payment of premiums, ensuring that the policyholder retains some value in their policy. Question 11. Which of the following is a characteristic of a term life insurance policy? A. It provides coverage for the insured's entire lifetime without the possibility of renewal. B. It has fixed premium and accumulates cash value over time. C. It provides coverage for a specific period and does not build any cash value. D. It is renewable after the policy term ends without any change in the premium. Answer: C. It provides coverage for a specific period and does not build any cash value. Explanation: term life insurance is designed to provide coverage for a specified term, e.g. 10, 20, or 30 years, and does not accumulate any cash value over time. The policyholder pays a premium for coverage during the term, and if they pass away during that term, their beneficiaries receive a death benefit. Term life insurance typically has lower premiums compared to permanent life insurance policies, but does not offer any cash value accumulation or investment components. Question 12. Which of the following health insurance policy riders would allow an insured to purchase additional coverage without proving insurability in the future? A. Waiver of premium rider. B. Guaranteed insurability rider. C. An accidental death and dismemberment rider. D. Impairment rider. Answer: B. Guaranteed insurability rider. Explanation: the guaranteed insurability rider allows the policyholder to purchase additional coverage at certain intervals, e.g. every 3 years, without needing to provide proof of insurability, regardless of their health status at the time. This is especially beneficial if the policyholder's health deteriorates after the initial purchase. The rider typically comes with certain age restrictions and limits on the amount of coverage that can be purchased. Question 13. Scenario question. Emily has been diagnosed with a serious health condition, but her life insurance policy is still in force. She is concerned about how this diagnosis might affect her premiums if she applies for additional coverage. What should the insurance producer explain to Emily about the impact of her health condition on her life insurance policy? A. The policy cannot increase premiums due to her health condition because life insurance premiums are fixed for the policy's life. B. The insurance company may increase her premiums or deny coverage when she applies for additional coverage based on her current health status. C. The insurer can only deny her additional coverage if she applies within the first year of the policy. D. The insurer will immediately cancel her policy if they find out about her health condition. Answer: B. The insurance company may increase her premiums or deny coverage when she applies for additional coverage based on her current health status. Explanation: when Emily applies for additional coverage, the insurer will likely conduct a review of her health status. This may involve a medical exam and assessment of her diagnosis. If her health condition is considered a higher risk, the insurer may either increase her premiums or deny the additional coverage application altogether. Insurers assess each case individually, and policies with a medical exam may reflect the impact of health conditions on premium rates. Question 14. Which of the following health insurance plans would typically provide the highest level of coverage and most flexibility in choosing healthcare providers? A. Health Maintenance Organization, HMO. B. Preferred Provider Organization (PPO). C. Point of Service (POS) plan. D. Exclusive Provider Organization (EPO). Answer: B. Preferred Provider Organization (PPO). Explanation: a PRPN typically provides the highest level of flexibility, allowing policyholders to see any healthcare provider without requiring referrals. PPO plans generally offer coverage for both in-network and out-of-network care, though out-of-network care typically comes with higher out-of-pocket costs. In contrast, HMO plans require members to choose primary care physicians (PCPs) and get referrals for specialist care, providing low flexibility in healthcare choices. Question 15. Which of the following statements is correct regarding the time limit on certain defenses provision in a health insurance policy? A. It allows the insurer to deny a claim for a pre-existing condition after 2 years. B. It allows the insurer to deny coverage for any reason during the first year. C. It allows the insurer to deny coverage for a misstatement of age at any time. D. It prevents insurers from denying claims based on pre-existing conditions after the first year of coverage. Answer A. It allows the insurer to deny a claim for a pre-existing condition after 2 years. Explanation: the time limit on certain defenses provision in a health insurance policy specifies that after 2 years from the policy's issue date, the insurer can no longer contest a claim based on pre-existing conditions unless the policyholder misrepresented or omitted information on the application. This period ensures that the policyholder cannot be indefinitely subject to claim denials for pre-existing conditions and gives them more confidence in the policy's long-term security. Question 16. Which of the following best describes the waiver of premium rider in a life insurance policy? A. It allows the insurer to waive premiums for the policyholder's entire life if they become disabled. B. It waives premiums if the insured dies within the first 2 years of the policy. C. It waives premiums if the policyholder becomes totally disabled and unable to work. D. It provides the policyholder with an additional death benefit in the event of disability. Answer: C. It waives premiums if the policyholder becomes totally disabled and unable to work. Explanation: the waiver of premium rider allows the policyholder to stop paying premiums if they become totally disabled and are unable to work. This rider ensures that the policyholder does not lose their life insurance coverage due to an inability to pay premiums during a period of disability. It is typically triggered after a waiting period, and the coverage remains in force as long as the disability persists. Question 17. Which of the following is true about the non-cancelable provision in health insurance policies? A. The insurer can cancel the policy if the insured misses a premium payment. B. The insurer cannot change the policy's premium rates but can reduce the coverage. C. The insurer cannot change the premium or cancel the policy except for non-payment of premiums. D. The insurer can change the terms of the policy at any time during the policy's term. Answer: C. The insurer cannot change the premium or cancel the policy except for non-payment of premiums. Explanation: a non-cancelable health insurance policy provision ensures that the insurer cannot cancel the policy or change the premium rates as long as the insured continues to pay the premiums. This provides long-term security for the policyholder. The insurer is also prohibited from reducing coverage or making significant changes to the policy's terms unless the insured fails to meet the premium payment requirements. Question 18. Which of the following would not be a typical exclusion in a health insurance policy? A. Injuries sustained while participating in a hazardous occupation. B. Claims for injuries resulting from war or acts of terrorism. C. Medical treatment received outside of the country. D. Regular physical exams for preventive care. Answer: D. Regular physical exams for preventive care. Explanation: regular physical exams for preventive care are typically covered under most health insurance policies, especially under preventive care benefits mandated by the Affordable Care Act. However, exclusions often apply to treatment related to hazardous occupations, injuries sustained in war, and medical care received outside the United States. It is important to read the policy's exclusions to understand what is not covered. Question 19. Which of the following statements is true about life insurance policies with a cash surrender value? A. The policyholder can withdraw the entire cash value without any penalties after 5 years. B. The policyholder can access the cash value, but doing so will result in the cancellation of the life insurance policy. C. The cash value can only be used to pay premiums, not for loans or withdrawals. D. The cash value grows tax-free, but the policyholder must pay taxes on the gains when withdrawn. Answer: B. The policyholder can access the cash value, but doing so will result in the cancellation of the life insurance policy. Explanation: life insurance policies with a cash surrender value allow the policyholder to access the accumulated cash value during the life of the policy. However, if the policyholder withdraws the cash value, the policy may be cancelled or reduced. While the cash value grows on a tax-deferred basis, withdrawals or loans taken against the cash value may have tax implications. If the policy is surrendered, any accumulated value may be taxed. Question 20. Which of the following best describes the difference between a qualified and non-qualified retirement plan? A. A qualified plan offers no tax advantages, while a non-qualified plan does. B. A qualified plan must meet specific IRA requirements and offers tax benefits, while a non-qualified plan does not have to follow these requirements. C. A non-qualified plan can only be used by government employees, while a qualified plan is available to private employers. D. A qualified plan is not subject to tax penalties, whereas a non-qualified plan is. Answer: B. A qualified plan must meet specific IRA requirements and offers tax benefits, while a non-qualified plan does not have to follow these requirements. Explanation: a qualified retirement plan meets specific requirements set by the IRS, which allows for tax advantages such as tax-deferred contributions and growth. These plans, such as 401(k) and IRAs, must comply with government regulations. A non-qualified retirement plan, on the other hand, does not have to meet IRA requirements and does not receive the same tax benefits, although it offers more flexibility in terms of contribution limits and plan structures. Question 21. Which of the following is a primary function of the reinsurance market? A. To provide financial assistance to policyholders in case of a claim. B. To allow insurers to share risk with other insurers. C. To underwrite policies for health insurance. D. To set premium rates for life insurance policies. Answer: B. To allow insurers to share risk with other insurers. Explanation: reinsurance is a practice where one insurer, the ceding company, transfers a portion of its risk to another insurer, the reinsurer. This helps the primary insurer manage risk exposure and protect against large losses from claims. Reinsurance does not involve underwriting policies for individual customers, but instead deals with the overall risk portfolios of insurance companies. Question 22. Which of the following is an example of an insurable interest in a life insurance policy? A. A friend purchasing life insurance on their friend's life. B. Business purchasing life insurance on an employee who is key contributor to the business. C. Neighbor purchasing life insurance for the benefit of another neighbor. D. Non-family member purchasing life insurance for the spouse of the insured. Answer: B. A business purchasing life insurance on an employee who is a key contributor to the business. Explanation: an insurable interest is a requirement for purchasing life insurance. It means the policyholder must have a financial interest in the life of the insured. For example, a business can purchase life insurance on a key employee because their death would have a financial impact on the business. Insurable interest can exist for family members, businesses, and others who would suffer financial loss in the event of the insured's death. Question 23. Which of the following would typically be excluded from coverage under a health insurance policy? A. Routine annual physical exams. B. Emergency medical services for accidents. C. Treatment for a pre-existing condition within the first year. D. Prescription drugs for chronic illnesses. Answer: C. Treatment for a pre-existing condition within the first year. Explanation: health insurance policies may exclude coverage for pre-existing conditions during the first year of the policy, although recent reforms in the U.S., such as under the Affordable Care Act, limit such exclusions in certain cases. Routine physical exams and emergency services are typically covered, and chronic illness prescriptions are often part of the coverage unless excluded by specific policy terms. Question 24. Which of the following is not an example of a legal source of authority for an insurance agent? A. Express authority. B. Implied authority. C. Apparent authority. D. Social authority. Answer: D. Social authority. Explanation: insurance agents operate under various types of authority, such as express, written or verbal, implied authority assumed based on actions, and apparent authority inferred by clients based on the agent's behavior. Social authority is not a recognized legal source of authority in the insurance industry. Question 25. Which of the following best describes underwriting in the context of insurance? A. The process of paying claims to policyholders. B. The process of determining the premiums for life insurance policies. C. The process of evaluating risks and determining policy terms and conditions. D. The process of selling insurance products to customers. Answer: C. The process of evaluating risks and determining policy terms and conditions. Explanation: underwriting is the process by which an insurance company assesses the risk involved in insuring a person or entity. Underwriters evaluate the applicant's health, lifestyle, or business conditions and decide on the premiums, exclusions, and coverage limits for the insurance policy. Underwriting does not directly involve selling policies or paying claims, although those activities are related. Question 26. Which of the following statements is correct regarding the free look period in a life insurance policy? A. The free look period allows the policyholder to review their policy for up to 30 days and cancel for a full refund. B. The free look period is only available if the policyholder was misled about the terms of the policy. C. The free look period begins once the policyholder submits a claim for benefits. D. The free look period lasts for only 7 days after the policy is purchased. Answer: A. The free look period allows the policyholder to review their policy for up to 30 days and cancel for a full refund. Explanation: the free look period is a provision in most life insurance policies that allows the policyholder to review the policy after purchase. If the policyholder decides the policy is not suitable, they can cancel it within a specified period, usually 1030 days, and receive a full refund of any premiums paid. This period allows the insured to make an informed decision without being locked into the contract. Question 27. What is the purpose of an accidental death rider in a life insurance policy? A. To provide additional coverage for death resulting from an accident. B. To pay for funeral expenses in case of an accidental death. C. To waive premiums if the insured dies due to an accident. D. To cover medical expenses related to an accidental death. Answer: A. To provide additional coverage for death resulting from an accident. Explanation: an accidental death rider provides an additional death benefit if the insured dies as a result of an accident. It typically pays out an amount that is higher than the base death benefit in the event of an accidental death. This rider is designed to offer extra financial protection in case of accidents, which are generally considered high-risk events. Question 20. Which of the following types of life insurance policies would most likely have a cash value component? A. Term life insurance. B. Whole life insurance. C. Accidental death and dismemberment insurance. D. Critical illness insurance. Answer: B. Whole life insurance. Explanation: whole life insurance is a type of permanent life insurance that provides coverage for the entire life of the insured, as well as a cash value component that grows over time. A portion of the premiums paid goes into a savings account, the cash value, which the policyholder can borrow against or withdraw during their lifetime. Term life insurance, in contrast, does not have a cash value feature. Question 29. Scenario question. John has a $100,000 life insurance policy with a 2-year contestability period. If John dies within the first year and the insurance company discovers that he misrepresented his medical history on the application, what is most likely to happen? A. The insurance company will deny the claim as they discovered the misrepresentation. B. The insurance company will pay the death benefit as the misrepresentation is not significant. C. The insurance company will offer a reduced death benefit based on John's age at the time of death. D. The insurance company will pay the death benefit regardless of the misrepresentation. Answer: A. The insurance company will deny the claim as they discovered the misrepresentation. Explanation: during the contestability period, typically the first 2 years of the policy, the insurer has the right to investigate and deny a claim if the insured misrepresented important facts on their application. If the misrepresentation is material to the risk of insuring the individual, the insurer can deny the death benefit even if the insured dies within the first year. Question 30. Which of the following is an example of a moral hazard in insurance? A. An insured individual intentionally causes damage to their property to collect a claim. B. A policyholder misrepresents their medical history on an insurance application. C. A policyholder engages in risky activities that increase their chance of needing to file a claim. D. An insured person fails to maintain their property to reduce the likelihood of a loss. Answer: A. An insured individual intentionally causes damage to their property to collect a claim. Explanation: a moral hazard refers to a situation where the behavior of the insured increases the likelihood of a loss or claim often due to the financial protection provided by insurance. In this example, the insured intentionally causing damage to their property to receive. A claim payment is a classic example of moral hazard. It involves intentional actions driven by the expectation of financial compensation from the insurer.